Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. So in this course, we will be expanding on what we've covered in Mastering Risk Management 1. So just before I explain exactly what's involved in this particular webinar, can we just take a quick moment to make sure that you're aware of risks involved in trading the financial markets? So please do take a brief moment to familiarize yourself with our disclaimer. If you do need to stop this recording, then you're very welcome to do so. Okay, so as I was saying, this is a continuation. This is a progression from Risk Management 1. So let me explain what we'll cover. We're going to start with a brief review of Risk Management 1. So we'll look at a lot of the theoretical topics which were discovered in that particular webinar. And now we're going to actually look and hopefully show you how to apply a lot of those in the most practical of environments. So we'll start by practically considering the conviction of a trade setup. So that's something that's very important for every trader to take on board before they start making trade related decisions. Then we'll have a look at applying a risk-reward ratio to our decision-making process. And everyone is very aware of risk-reward as far as theory is concerned, but the practical application of it is also incredibly important. Then we'll have a look at how you go about working out notional trade size and what it means and how you can interpret it. We'll have a look at how much risk do we actually want to take and making that decision and considering this point prior to getting involved in that trade or entering that trade is also very, very important. And also calculating exposure levels. So like we've discussed in webinar 1, it's not just about the individual exposure, it's also about the overall exposure as well of that trade. Then we need to just reconsider whether we are being accurate in our approach, and is there ways in which we can improve our accuracy when we trade. And finally, we'll just put it all together for you. So hopefully you'll find this webinar very, very interesting indeed. Okay, so let's start with a review, a brief review of Risk Management 1. So risk management is all about a trader's ability to effectively do three things. Firstly is to assess and quantify the potential for loss. And there's obviously a variety of ways in which you can do that, of course. Then risk management is about a trader's ability to actively manage the potential for losses on an ongoing basis. So it's not like you need to make a decision from the outset and almost have perhaps what your stop loss in place and just fully accept and almost forget to manage that particular trade as well. Whereas active management is actually a comprehensive part of any risk management approach. And finally, to look to take opportunities to mitigate potential loss wherever possible, if you possibly can. Now, it's obviously not relevant to each and every trade, but certainly if you can take that opportunity to mitigate risk, it does form a part of a trader's ability to manage risk effectively. Okay, so we also looked at conviction trading, and a definition is just simply a strongly held belief or opinion to achieve a particular desired outcome. So assessing the characteristics of each trade is quite important in terms of being able to determine what sort of conviction you should have in that trade, how much confidence do you have for a successful outcome, and make trading decisions based around that. So the more reasons you have to get into that particular trade, the more confident you'll feel about it, potentially even perhaps the more risk you will look to take on that particular trade in exchange for a considerable return. So it's weighing up the pros and the cons and looking at the characteristics of each individual trade and almost assigning a certain level of conviction to each and every trade that we take. So that's very, very important. Also, just touching briefly on positive and also negative risk rewards, and just a brief outline about a positive risk reward ratio is effectively when you make more when you take a winning trade than when you experience a losing trade. So in this example, let's say every time we achieve a winning trade, it would mean a monetary return of approximately 100 euros. But when you take a losing trade, maybe it's a 50 euro losing trade. So that's a positive risk reward, because when you win, you are making more money when you win than when you lose. And it's the opposite also applies for a negative risk reward ratio. So this is when you make less when you win than when you lose. So a good example would be exactly the opposite way around. Every time we take a winning trade, on this occasion, we would see a 50 euro return. So the idea is you'd increase your win rate quite substantially, which means you'd need to be correct more often than incorrect. Otherwise, you'll start making losses. And in a situation with a negative risk reward ratio, you'd be looking at realizing a 100 euro loss on a 50 euro win trade. So therein lies your negative risk reward ratio in that situation. So we looked at those topics in some detail. We also looked at notional trade size. So a definition of notional trade size is the overall position size value of a leveraged trade, wherein a small amount of invested money can control a much larger position in the market. So that's the benefit of leverage as a principle. Now, accurately calculating trade size is an important component of a solid risk management strategy. And really, your understanding of a notional trade size will really assist you with knowledge and understanding about the size of trade that you should be taking. And it's another way to just confirm and consolidate the size of trade that you should be in, and the impact to alleviate potential errors and mistakes from your trading. Okay, so that's a little bit on notional trade size. And we also looked at individual exposure, how much we're exposing in our trading for each and every trade that we take. That's obviously an important consideration, but also just as equally as important is that if you are in a number of trades at any one particular time, to have an understanding about the overall exposure as well. So if all trades went against you, how much of your capital are you risking, and are you actually aware that you're risking that much capital? So these are all hopefully the questions you'll continue to ask yourself when you're looking to master risk management. So risk levels as well. How much risk should we be looking to take? What type of traders are we? Are really breaking down and identifying, do we assign a certain portion of our capital to that trade, or do we expose a certain amount of pips to that particular trade? So assessing risk level is very, very important. And also is accuracy. Is there ways in which you can be more accurate when you trade? Do you happen to be one of those traders that adopt a very gambling approach to trading, which is looking at the markets and just for no real reason either looking to buy or sell those markets on a hunch or a whim, because that's more akin to almost gambling and effectively what gamblers do. So that for successful traders is not their approach. So accuracy is actually quite important for those that are consistently profitable. And finally, we discussed in detail the impact that certain psychological state of minds can impact your trading adversely, whether you're wanting to strive for that extra few more pips, or whether you are fearful of what's going to happen in that market, so you're effectively frozen out, whether you're really excited or elated, or whether you're sad and you're struggling from a lack of confidence. Whatever the case may be, all of these issues can really impact a trader adversely. And there is ways in which you can use things like risk management as a tool to make sure that even if you're on a winning streak, you keep that ego under control, you stay nice and calm, and even if you do experience a losing streak, that you don't throw the whole strategy out the window and start from scratch because you're so frustrated. So there is definite aspects to trading financial markets that you can instill from a very, very early stage. And it is around these principles of, being aware of the psychology, not just your own psychology, but the psychology of the markets as well. Being accurate, having an understanding of risk and how much risk you should look to take, and monitoring those exposure levels and overall exposure levels. So really putting it all together is so very, very important. And that's what we look to do and aim to do over the remainder of this webinar. So let's start with practically considering the conviction of a trade setup. So for this, I would like to just get up our trading platform, as you can see up on screen, and this just happens to be a euro-dollar hourly chart. And you can see over the last few days, you can see that there's been a bit of a move to the downside, and then we get a little bit of range-bound market price action. So this is quite interesting for those perhaps that look to break out, to capture breakouts in markets, because they look for periods of consolidation. And just to apply a fairly simple process, I'm going to just take note of the high here at this high, which you can see up on screen, and it's 123.44. So I'd just like to mark that particular high with 123.44 to the upside, and I would like to do the same to the downside. I think this is the low, so we'll work with the 22.81 level to the downside. So 22.81. So really we've got this range bound market bouncing from highs to lows. So we know which direction this market is moving in. It is, for the time being, it is moving sideways. So we are aware of this. So those traders that look to trade breakouts would like to do one of two things. If price breaks above the 23.44 level, they would look for an opportunity to reverse and unwind this particular move to the downside, and they'd like to capture a bit of a reversal in this market. So a bit of a move like so in this market, pushing those prices higher. So that's what your breakout traders that would see and experience a breakout above the 23.44 would be looking to capture. But so too would the same breakout traders if price decided to break beneath the 1.2281 level. They'd be looking actually for prices to start pushing lower. So whether we get a break to the upside or to the downside is not so important. Because what we'd want to do is we'd want to take a little step back and see what is the overall price action of this market. So it's very easy for traders to get involved in the right here and the right now, but what is the context of this trade? How much conviction do we have if we get a break above the 1.2344, or even for that matter, if we get a break below the 122.81. So for this, we can simply zoom out and just try and capture a little bit more price action. So we can start identifying sort of pretty significant swing highs and swing lows. And as you can see, this is quite a choppy market for all intents and purposes. And I'm just monitoring these levels down here. So just looking for major swing highs or swing lows, and these can be classified as support and resistance levels as well. So we'll just place all of these levels in this market, and I'll just do one more to the downside. So what we can just generally see is that this is quite a choppy market ranging from highs to lows, and we're currently in the middle of a fairly choppy price action. I hope you would agree with this. So if we get a break below the 122.81, do we get the opportunity for a really nice swing to the downside? Well, we can see that there is a significant level of support around the 22.37. So there is a move to the downside, but it might not be long lasting. And I'm just looking at some of these levels in here as well, which could provide a little bit of support, preventing prices from squeezing lower. So actually, in this situation, a breakout to the downside is currently not looking overly exciting for those that look to trade breakouts. So let's look again to the opposite side. If we get a break above the 123.44, would we be a little bit more optimistic about a profitable trade to the upside? The answer is potentially yes. That is the case. Now, what we're looking at more recently as well is a series of potentially lower highs in this market. And if this market decides to break above this particular level and starts pushing higher, then the 122.81 becomes a significant level in this market as well. So with this in mind, we're in very much a range-bound state. So and just do acknowledge, we'll come back to this in the second when we start looking at positive and negative risk-reward ratios. But in terms of the trade setup, I think we could categorically say that a trade would exist. Now, we might have slightly more conviction to the upside than we do to the downside. And this is the judgment call of a trader. And you'll obviously live and die by the decisions you make. So, so if this market creates what's called a double bottom and we start creating a structural failure above the 123.44, then the conviction for this trade might be slightly greater to the upside. So we might suggest that a breakout above the 123.44 might constitute a slightly higher conviction trade, maybe potentially a two-star trade to the upside. So I'll just make this little star in here. Whereas a trade to the downside based upon our analysis would still exist, but it might be more of a one-star trade in this particular example. So that's how we can formulate an opinion based on whatever your strategy may be. I'm just adopting the thinking of a breakout trader who would like to look to capture either a breakout to the upside or to the downside, and they'd be very knowledgeable and they'd be looking at this sideways moving market and looking to capture on a breakout in either direction. But can you see how we can assign a slightly different conviction? So we might slightly increase our risk going to the upside. We might look to get into the downside, but we might reduce the risk slightly. And that's really how traders implement conviction and assigning a certain type of status to each and every trade that they take. So I hope that makes a little bit of sense. So moving on with the presentation then, let's take that information and let's carry it forward. So it's very important to consider the conviction of a particular trade setup. But now, how do we go about applying risk-reward ratios to our decision-making process? So for this as well, we'll revert back to that same chart and we'll have a look at our decision-making process from a risk-reward perspective. Now we've put in our genuine levels of support and resistance in this market. So let's zoom back out just a little bit more. So we can clearly identify that the market has bounced off, and what I'll do to just represent that is to just place another level in here. So we do have a major swing low, but we do have these smaller intraday swing lows as well. So it can absolutely provide support around the 22.59, but there is another level below it at the 22.37. So all of this information is really useful for those technical breakout traders. And if we look to capitalize and capture a trade around the 122.81 level, which is just in here, then we need to assess what would be the risk reward of this trade. So a breakout trader might look to sell at this particular level and might decide to place their stop loss at this particular level. So They're keeping their stop loss way outside this sort of range bound market, and they're looking to capture a little move to the downside. So they may have a level or a target, maybe around the 22.37 in mind, and now they'll need to assess whether this trade is worth taking, bearing in mind there is another level of support around the 1.2259 level. So if we get in at 122.81 and the market starts to move down to that level, and we place our stop loss at this level in here, the 23.44. So that is our risk exposure in this market. So really, we need a multiple of that in order to see even a one-to-one positive risk reward. Would we get that in this particular trade? No, we wouldn't. At best, we would be able to secure if price did move down to this lower level down here. We're talking about a 0.5. So I'll put this in here, 0.5 to 1. So this is a negative, I'll put negative in here, risk reward ratio. So that needs to be taken on board as a part of the decision-making process from each and every trader looking to trade that market. Is this return enough for that risk? And this is a very individual trading decision to make. So the likelihood of this market getting in, moving to the downside, not hitting our entry, but reversing completely and stopping us out, obviously the likelihoods of that happening are probably less. However, you must realize and take on board the fact that a lot of these markets are so volatile, you can get major swing moves very, very quickly. You got to ask yourself, do you want to expose this amount of capital in order to benefit from this amount of potential return? And that's the trade-off, risk return. How much risk do you want to take, and therefore how much return do you want to see? So if we're trading this to the downside, we could be looking at certainly a negative risk reward trade. But let's turn this round and let's now just have a look and see, well, in actual fact, if we look to buy this particular market now at the 23.44 level, and we do the same, we look to place our stop loss just at this level down here. We have a significant stop loss, and if this market decides to break off this level, we could be looking for this market to push up to the 24.30 level. So as you can see, that has the potential to give you a considerable risk reward ratio on this particular trade. So what I'll do is I'll just put this arrow in here, because then we can judge, we can assess our entry price at 123.44. We can assess that in actual fact there's a 60, if our stop loss is at 122.81, there's a 63 pip exposure in this market. So 63 pips between our entry price and our stop loss, and we can see that there is the best part of 80. Let me see. So 86 pip gain. So as you can see, this is now plus 86 to the upside. So now this is a trade with a positive risk reward. So again, that can lend itself to assist you with your decision-making process. Is this enough reward in exchange for the amount of risk and the conviction that I have for this particular trade? And we'll just take a little margin. Let's say it's a 1.3 to 1 positive risk reward in that trade. So you might decide against a trade of this size based on its risk reward, but you might think a return of this for this type of setup on an hourly chart in a very volatile market might be worth taking. And therein lies the potential to make the decisions necessary to navigate these markets with an understanding of risk reward and risk reward ratios. So so again, hopefully that makes some sense. Just to move back to the PowerPoint, applying risk reward ratios to our decision making process can determine whether we have the conviction that we're looking to take, we have the characteristics that we'd like. Do we have the positive risk reward that we happen to be looking for, if that's our style, or does it even have the negative risk reward that we happen to be looking for, depending on what your style is? And applying that risk reward ratio to that decision making process is again a fundamental part of even an holistic approach to risk management, because you might discount a particular trade setup based on not being able to see and identify a viable trade because it doesn't meet your risk reward criteria. Okay, so moving on then, working out the notional trade size of a particular trade. So this is always let's say a difficult one. Now, it's important to know that whatever market it is you're trading, that that you can trade micro lots, mini lots, and also standard lots as well. And a good thing to show you would be to click on New Order, and if you click on the Volume tab, it will have a series of numbers. And this is the volume of the trade. This is the size of the trade in which you're trading. Now, each of these correlates to a certain pip value, let's say, depending on the size of the trade. And at 1.0 would constitute a one standard lot size trade in this particular market. Now, when we talk about notional trade size, and let's say we happen to take a particular trade size of 1.00 on a MetaTrader 4 platform. What this means in real terms is that we are trading 100,000 euros worth of USD. However, if we decided to take this trade, because we're trading with leverage, we can take a trade of this size and we can control that particular trade, but with much less capital than needing actually 100,000 in your trading account, which would obviously discount the potential for the vast majority of traders out there. So because of leverage, we're able to access these markets, we're able to trade much bigger size than we would ordinarily be able to risk and to trade, because we can benefit from what leverage can offer us. So one standard lot size is the same as trading 100,000 worth of euros in exchange for the actual relevant price that you actually execute this trade at. So at the moment, the price, and this is a live price, is 1.2302. So what this means is if we're taking a 1.00 size trade in this market, it means we're trading 100,000 worth of euro dollar at a price of 1.2301 now. So we get 1.2301 USD for each and every 1 euro exchanged. So that's worth knowing. And if you change the volume, you are considerably impacting and changing the size of the trade, and therefore the pip value of that particular trade. So just next to this 100,000, what I'm going to put is just the euro sign, So if we're trading something which is one standard lot size, we'll be trading £10 per pip. So I'll just put that in there. So that's important to know. If we decide to take a trade, but this time we're going to change the parameters of the volume, so we'll trade 0.10. And what this means now is we're no longer trading 100,000 euros. We're actually trading 1/10 of that. So now we're actually trading 10,000 euros worth of the base currency. And in this occasion, it is the euro against the US dollar. So the quote price is the current price, and this is quoting that we will get 23.01, 1.2301 for each and every euro. And the size of the trade now, because we've it's no longer 1.0, it's 0.1, which is 1/10 of the size of one standard lot size. And this is referred to as one mini trade. Now, what this means from a pip value perspective, excuse me, so that's the euro symbol. So now we are trading €1 per pip movement. So you can see the impact that this has on your trading account. You can see if you happen to be accidentally trading a size which is too great for you. You can hopefully now see the major difference. So this is one standard lot, and this is referred to as one mini trade. So I'll just put mini up here. So this is a mini lot. So we're trading 10,000 euros worth of US dollar in this example, because we are trading, the symbol we're trading is the euro dollar. And we also can trade smaller size than this. So we can absolutely trade much smaller than this. And for this, you can use the drop down menu. 0.01 happens to be what's called one micro lot. So I'll just put micro or MIC just in here. And what this means is we are now trading 1/10 of one mini lot. So for us in this example, we are now trading 10,000 euros worth of US dollar. And as you can see, we would divide the pip value, 10 cent per pip we would be trading now. So you can see how it can be scaled down quite easily, and hopefully you can see how easy it could be for traders to make very, very basic mistakes, where they might decide to take a one mini trade, one mini lot trade, and they happen to actually physically take a one standard lot size, and as a result, you can have some issues. So this is very fluid. It's very important you get familiar with the usual trade size, depending on which market it is that you're trading, and this will vary. A lot of this information will vary from market to market, so it's important you're aware of that. So that's just a basic understanding of notional trade size, that if you take any of these particular lot sizes, that there is the size of the trade, there is a notional trade size to that particular trade, and it's worth realizing and understanding exactly what that is, just from purely a knowledge and understanding perspective, and the impacts that can have on your trading account. So the final point I'd like to make about notional trade size is that if we happen to take a trade which is the 23.44 to the upside, and we have the 22.81, we can now work out that in actual fact this means that there is a 63 pips between your entry price and your current stop loss. So if we are trading one standard lot size, our exposure, in fact, I'll come on to this in a second when we start looking at exposure levels. So for now, what I'd like to do is just take this off the screen, because that is the next, that's some of the conversations we'll be having very, very shortly. So for now, let's look at how much risk do we want to take. Now, that's a very, very important decision for us to make as traders. Let's go back to our trading platform. So deciding what that risk amount should be is a big decision. There's a couple of factors you would need to take into consideration. And that could be, there's a couple of ways in which you could do it. And what we'll do is we'll get up our terminal just for the time being. Firstly, it's important to take note of the amount of capital you have available. And you could do it in two ways. You could firstly look at the monetary value of that particular trade, or you could also look at the pip value of that particular trade. So at this point, it'd be quite useful to bring this back up on screen, because if we have a 63 pip exposure in this particular market, and let's say we happen to be trading a 1 mini lot trade, which is 10,000 euros worth of USD. We know that there's a one euro pip value per pip movement. So what we do is we'll times this by 63. So what that means is our exposure for a 1 mini lot trade would equal 63 pounds. So it's just the number of pips times your pip value, which in this particular occasion, because we're trading 1 mini lot, it works out as €1 per pip movement. So for that, our exposure is 63. So so let's say we happen to be trading a 5,000 USD account, and our overall exposure happens to be 63 euros. Then that means that if we decide to go ahead and take this trade, then that can be correlated to a risk exposure of about 1.3, 1.4% of our capital in this particular trade, just allowing for the currency exchange as well, just to make things a little bit more difficult. So we're talking about a 1.3% risk exposure in this particular market, and we need to decide, are we comfortable with that particular trade? Now, to just compare and contrast, if we were trading one standard lot size with a 63 pip exposure, the cost of that, or the potential exposure, would be 630 euros. So can you see the difference? Hopefully it'll be very clear to see and identify that if you decide to take on much more risk in that trade, actually your exposure is so much greater. So we could easily jump from a 1.3% to what is effectively 13% of your capital in one particular trade. And the same applies to the downside. If we're comfortable with 1.3%, and we decide to take a 1 micro lot, then it's a 0.13%, which in actual fact wouldn't really make it even worthwhile for you. So it's important to weigh up the amount of risk that you want to expose in that particular trade. So for us, with our account size, that kind of risk exposure is definitely worth taking. So we could proceed on that particular basis. So just having a look again very briefly at the presentation, calculating those exposure levels is of real importance when we trade these markets. So it's not just a simple decision about how much risk do we want to take per individual trade and almost proactively looking to calculate that, we also want to have a basic understanding about our overall exposure levels. So for this, we'll get back up the trading, and we'll just bring up this information here on the screen. Now, let's say we could take 3 individual trades, but we decide to increase our risk on some of those. So let's at least double our risk on these particular trades. So we have a 63 pip exposure. We decided to take 3 of these trades. But what we've done is we've doubled. Instead of trading 1 mini lot, we're actually trading 2 mini lots. We'll stick with the example of 63 pips. So straight away, we could be exposing 126 euro on trade number 2. So this will be trade number 2. And we could be doing the same again on trade number 3. So all of a sudden, we're in 3 individual trades. We've done our individual risk tolerance, so we know exactly kind of the amount of capital we want to be exposing ourselves in each of these trades. But we've taken multiple trades now. So now the idea is, do we have a comprehensive understanding about our overall exposure levels? So for this, we can just calculate exactly what that will be, and we'll have 2, 4. So I'll just put this down. So our overall exposure levels for these particular trades is now, let's say, a considerable amount of our capital. And really, it's just important that we are aware and we can calculate exactly what these levels actually are. And that's what's important. And hopefully that's what you'll take away, is not just having an understanding of the not just having an understanding about the individual exposure, but the overall exposure as well, and how things, if you decided to take, if your third trade, you were so confident in it, you decided to be a 1 standard lot size trade, then your exposure to this market could actually increase exponentially, and now all of a sudden your exposure is excessive. And you could be talking about, 25, 30% risk on this particular trade. So that's how we can formulate an understanding of not just individual exposure levels, but actually overall exposure levels as well. Okay, so hopefully that makes sense. So how much risk do we want to take, making a solid judgment based on hopefully predetermined approaches to risk management, and then that ability to not just calculate individual exposures, but also overall exposures as well. So the next topic really is about practically applying accuracy in what we do. So when we look at the charts now, we can ask ourselves, can we be a little bit more accurate the way we trade these markets? And like, we've picked these levels and they are quite accurate levels. So just our entry prices and our stop loss prices are very, very accurate levels. They're based on highs and lows. You might want to build in a margin for error, maybe to the upside and to the downside. And I can see there's the 2350 level, which is just above it. So that might be used as your actual entry level. So for the purpose of demonstrations, we want to just focus on the fact that our accuracy levels, are we being as accurate as we possibly can when we trade these webinars, when we trade these markets. And then when we drill down in a little bit more detail in terms of what's our monetary exposure, do we have an understanding of that? Are we quite accurate with it? Do we understand what the notional trade size for each market is? How much capital If we were trading without leverage, would we be actually exposed in this market? What is the size of that trade? And just begin to put it all together from a perspective of accuracy. And the more accurate you are, the greater your likelihood is for success as well. So it's a very firm piece of a toolkit that is very, very important for each and every successful trader out there. So that's just a little bit on looking to be as accurate as you can when you trade these markets. Whatever numbers you happen to be working with, you need to work with really solid, objective numbers that people can't necessarily argue with. You're not picking numbers out of the sky. Hopefully that's really not the approach. If you are looking to master risk management, then do take on accuracy the best way you possibly can and try and embrace it and try to be as accurate as you possibly can with each and every trade. And then just finally, just to finish up, looking to put it all together. So what are we looking to do? We are looking to assess the conviction trade in this particular market. So for us, some of the decision-making processes would constitute as follows. So we are looking we're going to be nice and patient, and we're going to wait actually for a breakout of the 2344. We've got an understanding of the fundamentals behind this market and what's happened previously and potential news impacts that can impact those trades. We have the nice we have price action which has come before it, which is quite bullish. We would have a nice breakout above a consolidated market. We'd have the risk reward that we're looking for. We would be buying above a fairly significant level of support in this particular market. So all of a sudden you keep sort of identifying more and more reasons to take this trade. It adds to the conviction of this trade, and for all of those reasons we are looking to buy above the 123.44. So we do ask ourselves about that risk reward ratio. Do we have the risk reward ratio that we'd be looking for? And the answer is yes, we do. Now the calculation of risk and trade size, let's say we fully understand that we actually want to take a 1.3% risk on this trade. We know and we understand, and we've done the calculations, that the pip exposure in this particular example is approximately 63 euros, because we are going to trade one mini lot in this particular example. We know exactly what all the levels are, so we can go ahead and look to book this trade in. So we'll click new order. So we want to make sure we start with getting our volume absolutely correct when we take this trade. So we know exactly what our stop loss levels, and in actual fact what we're going to do is, the current price is around 122.89. We only want to buy at this level, the 23.44. So we obviously have to wait for the market to get to that price. That's not necessarily a bad thing. So what we can use is what's called a pending order. And in this example, we're going to work with a buy stop pending order, meaning we're looking to buy this market above the current price. So that's what a buy stop order means. And now we can work with these levels. So from a risk management perspective, do we know and do we understand, if we get into this market to the upside, do we know and understand exactly where we'd like to place a stop loss? And the answer is yes, absolutely. We know exactly where we want to place that stop loss, and it's the 122.81. So you can see that we're being very accurate with both our volume and our stop loss, and we've got a basic understanding. So the next thing we can ask ourselves is, right, well, if we get a break of the 123.44, what price would we be looking to take profit? And that could be a straightforward decision as well, depending on your analysis. So we could just look to aim for the 124 30 in this particular example. So it gives us that excuse me, it gives us that positive risk reward ratio that we'd be looking for. So now all it asks us to do is to confirm exactly what the price is that we want to get into this market, and it's 1.2344. But always before you get into a trade, just check the trade conditions, make sure everything is as it should be. Is the volume correct? Is the stop loss exactly what we're needing? And the answer is yes, it is. The take profit, this can all be a part of your trade management process as well. You might have to take profit at a slightly lower price, who knows, but that's about your ability to manage that trade, which is also an effective part of risk management. And the price that we want to get in, you just want to double check it, make sure it's correct. And then once you're happy with that particular trade, whatever that may be, then you will be able to take that trade and you'll be able to post you'll be able to see, should I say, that trade in your terminal. So we can look at this and we can identify that the trade size is correct. It was the trade size that we were wanting to trade, meaning we know our exposure level is around 63 euro on this trade. It's a buy stop order, so we're placing a pending order in this market, waiting for the market to come to us. And it's another useful tool when it comes to risk management, your understanding of pending orders as well. We know exactly what price we want to get in at, 23.44, so we're very, very accurate. And if we get a break to the upside, we want our line in the sand to be 122.81. And we do have a take profit at the 124.30 level, just up on here. So this is really the process of looking to, as a trader, to look to put this information together and allow it to inform your trading related decisions as you progress and as you become more comfortable in those decisions. So just to review what we've covered, we obviously just touched upon risk management 1. We had a look at the conviction of a trade setup. Now I just used a breakout trade style trade setup for the purpose of this particular webinar. And then we looked at the pros and cons of applying risk reward ratio and how that can impact our trading decisions in terms of discounting an opportunity to perhaps take this trade to the downside, but leaving us open to the potential for the market to push higher. Then understanding notional trade size and the impact that can have on your trading, and how and why it's very, very useful for you to know and understand what notional trade size is. And then we just finished off with how much trade do we want to take. Well, for us in this particular example, it was fairly straightforward to work that out. We know we were roughly risking approximately 63 euros of our capital, which is 1.3%. If we had a situation where we were very comprehensive with our individual risk management calculations, but also if we took multiple trades, we'd have to have an understanding of our overall exposure levels, just in case all of those trades decided to turn against you at the same time. And again, it's about knowledge and it's about understanding the dynamics of what you're doing, and awareness is everything, and that's really what we're trying to be advocates of. And then just touching upon your ability as a trader to be as accurate as you possibly can. The more accurate you are, the more success you'll see over the medium and longer term. And then finally, we just put it all together in terms of being able to place a trade with a strong emphasis of risk management, knowing and understanding exactly how much that risk was we were looking to take, and working with accuracy in terms of knowing precisely what our entry price was, what our stop loss price was, and also what price target we were aiming for in that trade. So all that's left for me to do now is to obviously thank you very much for joining us. We do hope you've enjoyed and benefited from this particular webinar. So thank you all for joining us. Do take care, and we look forward to seeing you next time. Bye for now.